Welcome to Real Estate Economics weekly webinar series. Real Estate Economics is a leading provider of residential market consulting and online research tools. Every week we present a webinar covering a variety of topics ranging from the nation, a particular state, an MSA, a topic of special interest. This week we're going to be presenting the Denver Aurora MSA. Next week, join us for the Ventura County, California series. That will be at 9 a.m. posted to YouTube at 9 a.m. on Wednesday. Please go to www.youtube.com/real estate economics, all spelled out. I'll be presenting Denver to you today. My name's John Mulville. Most of the information you'll see today comes from our residential economic report, which is very useful in providing a good gauge of activity in these particular market areas and gives you a great bearing on what's taking place from place to place across our service area, which includes California, Nevada, Arizona, Texas, Colorado, Florida. You'll be able to see economic trends, housing market trends, mismatches between supply and demand, so you'll know if there's upcoming demand's improving or declining, how the supply consideration looks like, what are the relationships between prices and incomes, and also our opportunity risk report, which will give you a good idea of market cycles and the opportunity to position yourself for market improvement or market degradation, as the case may be, in the periods ahead. For September, we're offering a 40% discount. Please contact our sales representatives, Judy Dool, D-O-O-L, at realestateeconomics.com, and Sandy Rivera at realestateeconomics.com. I'll provide that contact information later in this webinar. Let's start today with regional comparisons so that we can put our Denver, Colorado analysis into perspective. If we look across the West, many of the markets have a pronounced oversupply of housing, and it's commonly assumed that the oversupply was produced by rampant overbuilding and just builders putting up way too many homes than was really needed. What happens, in fact, is that supply tends to grow very slowly in almost all markets, and this oversupply of housing comes from a breakdown in employment. Once employment breaks down and many people begin to lose their jobs, the housing inventory that exists in these markets is far too large for the employment base. Now, the employment base tends to oscillate quite rapidly up and down, going from periods of oversupply to undersupply, but the condition we're in right now is the employment base is far too small for the housing inventory in many of these areas. So that produces this oversupply figure. You can see the most impacted markets are those with the worst job performance: Las Vegas, Inland Empire, Sacramento. These are the areas that have the poorest economic conditions and employment conditions and have resulted in the greatest magnitude of oversupply. Let's take on valuation. Now, the valuation is calculated by local household incomes and current interest rates, and what sort of payment responsibility that produces on a dollar of household income. As you can see, for the 2010 numbers in a place like Las Vegas, only 12 cents out of every dollar of household income is required to support the median home price in these markets. Let's do the math on that real quick. The median home price in Las Vegas, Nevada, as we speak today, is roughly $135,000. If you make 80% loan to value at a market interest rate, the payment to own that home is less than $600. You don't need that much income to qualify. Those houses are tremendously undervalued in comparison to decades-long metrics of household income and current interest rates. You can see the drop in the far right-hand column since 2006. In 2006, these homes were far overvalued. People could qualify for loans that far exceeded their financial capabilities. That manifests itself straight through to prices, so prices were completely out of sync. These markets have corrected, then overcorrected substantially. The only thing that's keeping these markets from recognizing this undervaluation and seeing some improved home sales and improved home prices is the economic conditions, the fact that every day in the newspaper jobs are lost and we've got economic calamity all around us. But ultimately, as confidence builds, people will recognize these undervaluations. This shows at the bottom the percentage losses since 2006. At the bottom are those markets which have had tremendous disruption in their employment markets. At the top, the Austin, Salt Lake City, our subject Denver, Colorado, and Dallas, those are the markets that for one reason or another avoided the bubble condition that took place as a result of subprime, and they did not experience a big run-up in prices. They did not experience increases in supply like the bubble markets. So those markets are left in a better position to not only hold their values presently, but to recover in the months ahead. Now, if you're living in some of these markets, it may not seem like that great of a deal, but compared to what's gone on in the most impacted markets in the West, they're faring fairly well and have much better prognosis for recovery. Let's talk about what got us into this mess. This is in the newspaper every day, but it's easy to forget the real numbers that took place on the ground. Look at loan-to-value ratios in the 2001 to 2006 time period. Those ran up from 80, which was, used to be considered a real conventional loan-to-value ratio, to 89 in that time frame. The number of 100% finance loans was really limited to government programs in 2001 and 2, but grew to nearly a third of the market action by 2006. Limited documentation loans, the famous liar loans we hear about quite often, went from a fairly high number, 27% in 2001, to 44% by 2006. Now couple those up and take the market volume for 100% financing and limited documentation, and you go from 1% in 2001 or 2002 to 15% in 2006. It's really this disconnect between the buyer's financial capabilities and prices that led to excessive demand and the price run-up that's got us in this problem now. So first we had a correction as the market returned to the area where buyers were financially capable. Now we're having the overcorrection where prices are dropping far below what incomes will support in some of these markets. Let's dig into the Denver area. One of the things that we're seeing in the civilian labor force is in this market and many others, the civilian labor force is declining even though we know the population's expanding. People are dropping out of the labor force because they're discouraged. If you look at how the unemployment numbers are calculated after you've expired your benefits, you drop off. You're no longer counted as unemployed and you essentially disappear. Those numbers or that process is making the unemployment numbers look better than they actually are, but we can tell nationally that the number of people in the workforce as a percentage of the total population is at a lower percentage than it has been since the 80s, over 30 years. That suggests to us that the employment losses are much more drastic than even we recognize now, and that many, many people would be in the labor markets if they could be. Here's unemployment rates for this market area. This is a 21-year chart. I apologize, the bottom dates are a little bit hard to read, but look at it as a 21-year time horizon. Denver performed quite well right through the middle of this particular chart when we ran into some difficulties with the dot-com boom, which did affect this area. This area has a big military and computer high-tech component that suffered here, but those problems from the dot-com era helped avoid a big real estate bubble in the mid-2000s. We still got rising unemployment associated with the credit crisis and the financial meltdown into the present day. But this area has actually been creating a few jobs, private jobs, not just public jobs, in the past few months, and so there are some inklings of improved employment here. We think that continues into the end of this year. However, come the beginning of 2011, we're going to have higher income tax rates and also taxes on employer-provided health benefits. We think that produces a reduction in take-home pay that the market's going to need time to adjust to. We think very few people are cognizant of that taking place, and when they come home in 2011 with lower take-home pay, we're going to have a period where they have to rebalance their budget there. Let's look at the yearly changes, the 12-month changes here. You can see our dot-com disruption in 2001, 2, and 3. That was quickly recovered in the middle of the decade, but again, you can see those growth numbers are nowhere near the 90s. So we didn't get an influx of construction workers. We didn't get an influx related to subprime construction, and therefore did not overbuild numerically as many markets tended to do. We've lost some jobs in 2009 and 2010, but the 5-year forecast is not really too bad here. Interestingly, polling has shown that many Colorado residents believe the economy is in a recession there. So there is a lot of fallout from that politically. We have a very interesting 3-way gubernatorial race, but in actuality, unemployment decreased in 50 of 64 counties in Colorado last month. Let's look at our shadow inventory. Everyone knows that the shadow inventory is distressed inventory in the pipelines of the various lenders, the banks, the agencies, the private label mortgage holders, that sort of thing. Many of these pipelines have a lot of units in them conceptually and actually that are very slow to come out. We've seen the banks announce huge ramp-ups in staffing of their REO departments, and it's only now beginning to produce a few more homes on the market. But we also recognize and have seen loan pools are being purchased by vulture investors and this sort of thing. So large numbers of homes are leaking out through processes that won't produce one-off sales transactions for some time. So in some sense, you could make a convincing argument that the shadow inventory, while sizable, might be somewhat overstated. We've also seen a situation where much of the distressed inventory does not meet the owner-occupant demand that efficiently. Most people out shopping for a home aren't willing to buy that foreclosure, don't want to wait for that short sale. You can clearly see the marketing of short sales and equity sales are different these days, as the distressed inventory has failed to seamlessly meet demand. We think that's a tremendous advantage for new homes over time. Here's a residential permit activity. This market peaked at about 35,000 back in 2002 and has dropped way under 5,000. We probably won't see 10,000 again until 2015. So this market is not adding a lot of homes, which will ultimately help rebalance our supply and demand. We want to show population growth specifically here to see and to analyze the age 55 to 64 category. That's a age bracket that's going to go from about 160,000 in the year 2000 census to about 302,000 in 2010 and over 350,000 by 2015 now. This should create tremendous opportunities in age-targeted and age-restricted programs. Even if you're building an all-age development, it's probably prudent to include some single-story floor plans and consider that buyer profile in your construction. There are going to be many people fleeing out of high-tax states like California, going to other states looking for lower cost of living, new living opportunities, and different safe, secure, low-maintenance environments for their retirement years. Here's our national 30-year fixed-rate mortgages. At present, the 2010 mortgages have been setting all-time lows. It looks like now the 30-year Fannie Mae rates are about 4.5. We reach a point of diminishing returns on these rates where lower bond yields don't translate directly into lower mortgage rates. We may be getting pretty close there. Ultimately, we believe the market's going to want to the government's going to want to exit this market and turn this market over to private providers. That's probably impractical. This market's become so huge that the private sources won't be interested unless the rates are higher. So we've got a little backup in rates here over the forecast period. That's the end of part 1. If you're interested in listening to both parts today, there's one more to come. Join us.